And I'll say one other thing on this. And I have had a couple of clients call a little squeamish about the market from 2001, from January 1 of 2001 to now. So now we're really going back, and I'm dating myself, okay? The markets have obviously done extremely well. If you miss 10 days of that market run up, you miss 54% of the return. So again, people need to resist that temptation. It's hard. You think you see something happening, this tariff thing, or whether it was COVID, and your natural reaction is, I'm going to get out of the way of this. And then when the storm is over, I'm going to come back in. The problem is when people are comfortable and come back in, they've missed 3 of those 10 days. Okay. And if that happens 3 times during your investment lifetime, if you will, you've missed it.
Welcome to a very special edition of Rise Up on Wealthion. I'm Terri Kallsen, and I'm happy to be with you here today as your co-host. And for the last several weeks, we've been highlighting the volatility in the market. And this week, it really reached a high for the year. Today, we're going to continue to deep dive into what's going on in the market, lots of questions, things going on about tariffs, policies, and then the U.S. economy. There's just been a lot going on. So today, we're going to try to spend some time digging in the markets, understanding what's going on, but most importantly, how do we help you grow and protect your portfolio, even in the midst of all this volatility? I know there's a lot of talk about potentially stagflation, even a recession. We're here to help answer some of those questions and hopefully help calm some of the waters. As you can see, my co-host, Joe Duran, is not with us today. It happens to be my birthday today, but Joe actually went to Florida. So isn't he a great guy to spend that time relaxing and enjoying Florida on my birthday? I feel so grateful. But anyways, we wish him well. But we do have 2 great people with us here today. Scott Schwartz, he again is the principal at Bleakley Financial Group. Scott has been with us many times and really has a wonderful way of helping calm his clients. And then we also have a special guest coming back, David Mandelbaum, who's the portfolio manager at Bleakley Financial. His specialization is healthcare. And we're going to talk a little bit about what's going on with healthcare this year. It's actually one of the potential areas that we can actually see some growth and protection for your portfolio. So Scott and David, thank you for being here today.
Thanks
for you, and happy birthday.
Oh, thank you. It's been a great day so far. And once I'm done here, one of my favorite things to do is go out and do Orange Theory. Have you guys ever done Orange Theory before?
On your birthday? That sounds terrible.
I know it's a strange thing, but it's one of my favorite things to do. My husband's going with me. So anyways, as we get through this, I'll be going out to increase my heart rate, which I know there's a lot of heart rate going on, heart rate going on in the market today. And we're continuing to see this volatility. U.S. stocks tanked to session lows on Thursday. The Dow Jones Industrial Average fell over 400 points. Down another 1%, while the S&P 500 nearly 2%. The NASDAQ plummeted more than 2.8%. The NASDAQ is now off more than 10% from the December record high. So we're hearing all this correction and what's going on. Scott, let's start with you for a market reaction, especially on the tariffs. President Trump is really moving forward. He expects some pain from Americans, but he's trying to reassure us that there's some calm out there. So would love to hear your thoughts on the volatility and what's happening.
Yeah, so speaking directly to the tariff question, I don't think anybody out there is crazy about the idea of tariffs. Someone's going to have to pay these taxes. The argument is, will the Chinese or the Europeans or the Mexicans or the Canadians pick up the slack? Will they be passed directly on, to consumers, and will that have a negative impact? And there's also this, notion that maybe they will be short term. And Trump is known for being a pretty good negotiator. He's tried this before. There was a lot of fear about tariffs, specifically in 2016 when they did this, and it turned out to be okay. The way I look at this kind of thing, Terri, whether we're talking about tariffs, whether we're talking about geopolitical strife, whether we're talking about rapid interest rate movements. I've been doing this for 40 years now, which is kind of hard to believe, but true. There's always a story. There's always a reaction. I look at the markets this morning and this afternoon, like everybody else. It gives me a little bit of a tummy ache. I'm not going to lie. But the reality is that these are the times when you've got to be patient. These are the times you've got to believe in your plan. And I've seen this. This is probably, if this actually becomes something, and it hasn't yet. Look, when you're giving back what you've made in the last 6 weeks, that's not exactly a market crash. So again, I think we need to check our perspective first and foremost. But I also think that the Mag 7 that has led this market for the last few years has gotten expensive. It's drugged the market up with it. If you look at where the carnage has been here very recently, it's been in those kind of tech names. I can tell you these are the days where you want to be in a diversified portfolio. At Bleakley, we're always there, and the time to prepare for things like this is not when it's happening, it's before. So I can tell you that our portfolios on the year are still slightly positive. Value stocks have held up fine. David's healthcare fund, believe it or not, through yesterday was up about 8%. The bond portfolios are rallying because rates have come down a little bit. So for people out there who aren't crowded in and weren't chasing that magnificent seven trade, if you will, they're doing fine. The people who did, unfortunately, they're feeling a little bit of pain, but I do think it's time to be patient, take a breath. This stuff will work itself out. We'll be talking about something else 6 or 10 months from now. But if you've got a well-constructed portfolio, you've got good balance, you've got a good liquid position, it's all going to be okay.
Yeah. Scott, it's really great to hear that. When we're in the storm, we don't even realize that there are really opportunities here. And the fact that Bleakley Financial Group still is positive on the year demonstrates the value of great financial advice. And, really, one of the things I love what you said is really make sure your portfolio is represented across all asset classes, right? Stocks, bonds, real estate, commodities. Make sure you have that balance. And then make sure you're looking for quality investments, like the fundamentals, like you said, solid earnings and low debt. And really what makes a difference too is good management. Do they have good management? Can they see beyond these turbulent times that we're experiencing now? So Scott, one of the things I was going to get you for your birthday, I think, just hearing you talk, is that you want to keep calm, right? A t-shirt that says keep calm, continue on. And if you have to drink wine or a smoothie or something, you should do that. But keeping calm, I think, is the key. So, I know you work with a lot of clients, and Bleakley is a fabulous firm. But, what are your clients asking you about this week, and what advice are you giving them?
Our clients, believe it or not, Terry, are extremely calm. I haven't had a single call, a single incoming call from a client this week. In my normal course of reviews, which I do several a day, I've had conversations and people are asking, they're a little nervous. What do you think? Again, the markets are very funny. In the last couple of years, we've had a non-US equity position because we want that balance, that non-correlation. Our non-US equities on the year are up 7 or 8%, right? When tech stocks were up 20 percent, and value stocks were lagging in the last few years, people didn't want to look at those stocks, but our value positions are holding up. David, as I said, has been a bolster. We have a global macro strategy at our firm that Peter Bookvar runs. When the stock market's up 23, people look at Peter and he's like, I don't want to be there. Why do I want to get an 8 or 9%? Why do I want to be with the guy who owns value stocks that are boring and gold and silver and that boring stuff? Well, when the market's down 10 and you're up 2 or 3, that's pretty good, right? So again, we've been here before. If you're non-correlated, I think I might have mentioned in a podcast we did a few weeks ago, Terry, that that being diversified always means having to say you're sorry, right? Because there's always going to be an asset class out there that's doing better. But diversified portfolios also save you in times like this. So if the market continues down at this level in a diversified portfolio, you're not necessarily going to be positive on the year, but you're certainly not going to get routed. There's plenty of assets out there that haven't run up dramatically, aren't very overvalued. So there's still room out there in healthcare stocks and value stocks. Non-US equities have been very unloved for the last 10 years, and they're rallying here relative to the S&P. So, I would tell people be patient, don't panic. And I'll say one other thing on this. And I have had a couple of clients call a little squeamish about the market. From 2008 to now, or I'm sorry, from 2001, from January 1 of 2001 to now. So now we're really going back, and I'm dating myself. Okay, the markets have obviously done extremely well. If you miss 10 days of that market run up, you miss 54% of the return. So again, people need to resist that temptation. It's hard. You think you see something happening, this tariff thing, or whether it was COVID, and your natural reaction is, I'm going to get out of the way of this. And then when the storm is over, I'm going to come back in. The problem is when people are comfortable and come back in, they've missed 3 of those 10 days. Okay. And if that happens 3 times during your investment lifetime, if you will, you've missed it. So you have to be patient, make sure that you've planned, hopefully in advance for this. Things will be fine. Things will recover. There's always going to be some news story.
Yeah, I love what you said about diversification means sometimes you have to say you're sorry, and you may be sorry that you missed out on that one stock, right? But you're not sorry that you missed out on that 10 days of which you lost 54% of your value. So like that is such a great story, and I hope the viewers hear that and aren't making any overreactions at this moment because it won't necessarily end well. But David, you're a portfolio manager as well. So interesting to you, what stands out for you and where are your concerns?
Yeah, I mean, we're clearly volatility is at elevated levels. It's up, last I checked, 44% year to date.
Yes.
And I think it's probably here to stay, just given the confluence of the macro uncertainties, policy risks, which are heightened for the healthcare sector in particular, and we could talk about that. But I think, to the point that both of you made is the importance of being disciplined, staying the course. For someone like me who invests with a deep fundamental research process behind it and constantly stress testing and doing due diligence on positions we're in, subsectors we're in, what's happening in Washington, is just stick to the process, be disciplined, and a mistake that is frequently made in periods like this is over trading. And I would strongly, I've not been doing this as long as Scott, but been doing it a couple decades, and that's always a recipe for disaster in periods of heightened volatility.
Absolutely. Let's move on now to the economic data that we've had come out this past week. And it's really shaking some confidence for investors. Thursdays, we saw some shocking numbers coming from the outplacement firm Challenger Gray and Christmas, who announced there were about 172,000 layoffs for February, up 245% just from January, and the highest monthly count of layoffs since July of 2020. So we have not seen this in several years. About 62,000 of those were attributed to DOGE federal government layoffs. And on top of that, ADP released its job data for February, noting that private companies added just 77,000 new workers, well below the 148,000 that were estimated to be added. So this report also showed tariff concerns as a sector that lumps together trade, transportation, utility jobs, saw 33,000 positions go away. So, this can get a little depressing at times. Scott, will you help us unpack this from the potential of any upside this could lead to for future Fed cuts, or how people should respond?
Yeah, I think that what's going on in the government right now is going to be painful. I think for some people, of course, I think we all agree, whatever our political views are, that the government's gotten very bloated. I don't think it's healthy when the biggest employer in the country is a federal bureaucracy. They're not particularly productive. So, there's going to be, some pain there. I think the severance packages, the way they're structuring this, I think it's not like there's going to be a lot of people on the street. I don't think it's going to affect things so much from sort of a consumer perspective. A lot of those people will be repurposed in the private sector. A little more concerning is some of the private sector layoffs you're talking about. But again, this is a cyclical world we live in. When there is uncertainty like this, when people are concerned about tariffs, they are a little less likely to maybe borrow some money or maybe to hire. They might be more inclined to lay people off. But it's all about comps too. We've been in an environment up until very recently where it's been very hard to find labor. Good people have been hard to come by. So, that offers an opportunity too. The cycles will shift. I can tell you at Bleakley, we're on a hiring spree. So if there are any really great people out there that have unfortunately been downsized, we're looking for good people, and most of our clients are still looking for good people. So again, it's a cycle. I wouldn't be too, concerned about it if it persists. Obviously, really high unemployment numbers are bad for people, bad for economies, but it doesn't feel like it's such a small period of time. We're so focused now on short periods of time because there's so much news out there. You can't walk anywhere without walking by a TV. In the morning, it's market sell-off. I mean, I see days where the tagline on MSNBC or CNBC is market sell-off, because the S&P 500 is down 75 basis points. For God's sakes, it could be up 7%, in the last 3 weeks. But again, this is the world we live in, where everything is, kind of hyperbolic. The market could very well be up 150 basis points tomorrow. We've seen those days too in the last couple of weeks. So again, I just think people should take a breath. We've been here before. The markets do go up and down. We're gonna have a down year at some point. As long as we've got enough liquidity, as long as we're not selling stocks, I would argue that we're not there yet, but we're getting close to maybe an opportunity here to buy some stocks that are good companies that might be selling off a little bit cheaper. Because some good stocks are, I think, being unfairly punished. So you got some.
Scott, I was going to say that when we, one of the questions clients consistently ask is, when should I rebalance, right? And this might be a time to rebalance. If you look at your overall portfolio now and you've lost on a few, you might want to buy to actually get that back up to what your risk tolerance is. So it's not about buying on the curve or on the down. It's about making sure that you're rebalanced and you're still set up at the risk tolerance that you want.
I think that's right. And if you really look at the numbers, though, in a lot of areas of our portfolios, we're just kind of back to where we started the year.
Yeah.
Right. So, what we try to do is keep an eye on where we are. I'd like to see equities come down about 5% below my target before I wade in. One mistake people make is a couple of bad days. They think it's so terrible that, I'm going to go in here and I'm going to rebalance and I'm going to buy equities there. You're better off being patient, right? You're down a couple, 3%. That's not necessarily a huge buying opportunity. You're kind of right where you want to be. 5%, that's sort of our bandwidth. With rebalancing, if we're up by about 5%, we're going to go in and do that. Maybe not a bad time if you've been dollar cost average to accelerate a little bit. But I think the best thing people can do is be patient. You own quality stuff, it's going to come back. It really will.
Yeah, just keep watching us every week, and that'll help you with your patience. It'll help you calm down.
And remember, the time is your friend, right? If you're in the equity market, you should be long term.
And both of you are leaders in the industry. You've all worked in the industry a while, but you've been leaders. And I think about some of our viewers, and I would guess many of them are worried if they potentially lose their jobs. And David, could you think of things that you might think about or start doing if people are afraid of losing their jobs? What should they be doing to protect themselves financially?
Yeah, I mean, raising cash and having more liquidity is certainly a logical approach to protecting against that risk. In terms of equity exposure, I agree with what Scott said 100%. One thing just to put some numbers around some of this stuff is, we could be in a period of where the broader equity markets could be challenged. And that's simply a function of the fact that we've gotten so top heavy with the Magnificent Seven. I mean, entering the year, I think we talked about this when I was on last, comprised 1/3 of the S&P 500. Now that's been a function largely of the fact that those 7 stocks have dramatically outperformed from an earnings growth perspective the rest of the market. 30 to 35% annual growth the last couple of years. The rest of the other 493 stocks flat. But that's expected to converge this year. Those Magnificent Seven still projected to put up robust growth, but decelerating to high teens, whereas the rest of the market should be double digit or so, and healthcare is going to accelerate even faster, mid-teens to high teens. Now, enormous divergence and dispersion, and that's where someone like me has to come in and identify the winners and reduce the risk for potential losers. But if this rotation continues and the Magnificent Seven is now down 16% from their December high, that's going to be a challenge for sort of passive index investing, but create opportunity for good active management as well.
Yeah, that's right. And, I was thinking about a lot of our viewers and, what could they do to keep their job, right? I mean, that's really, what do you need to do to make sure that you maintain your job? And believe it or not, I did a little research on this, nothing to do financially, but Korn Ferry actually put out a number of articles. Korn Ferry is a research firm about one of the ways you could keep your jobs. And guess what? One of them was the art of praising your boss. So if you want to keep your job, make sure you praise your boss. And they gave specifics. So, Scott and David, we might want to think about this, but,
Well, I did want to say Scott looks incredibly handsome today.
Thank you for noticing.
Well, you're modeling that perfectly, David, because they said be specific as much as you can and make sure that it's quality of compliment versus quantity, because bosses are smart enough, and if you're just brown nosing, they'll get right into that. So
no, I'm good with that. Terri, you say that we just had a conversation, my brother and I, as my partner, yesterday. We were talking about, what's happening out there. Some people are losing their jobs, sadly. A real easy thing, I think, if you're looking for a tip on that specifically, go back to the office, okay? The easiest person to fire is the person that you haven't laid eyes on or laid hands on in a while. And you've got, with the sort of change in our work environment the last few years since COVID, some companies have been very lax and, allowing people to decide whether they want to come back or maybe come back. We want you back at least 2 days a week. And a lot of people have gotten very comfortable working from home. And so they've become resistant to that. I would tell you that if my kids were working in a corporate environment or had a boss or any of my friends, my number one would be get back into the office, start rekindling and creating these relationships with people, because I can tell you as an employer, it's a lot easier to let somebody go who you haven't seen in 6 months than somebody that you see every day. Personal relationships matter, right? Personal contact matters.
And I would echo that because I have 2 young adult kids, and I stress to them, be present, be available, say yes, be proactive, follow up, be respectful, all the things that make you a valued employee. Just double down on that stuff.
That's great advice, you guys. Probably even more effective than just praising your boss. So thank you. But let's move into, David, I'd really like to think about you as really seeing the future. And you told us earlier this year that healthcare stocks actually are looking pretty positive when you were with us in early January. You said, don't sleep on them, but make sure that you understand what the opportunity is here. And as of Thursday, the healthcare sector is dramatically outperforming the S&P at more than a 6% return and versus a negative 2% for the S&P. So David, let's keep sharing the good news.
Sure. Yeah. I mean, I think that conditions are in place for that outperformance to persist, at least within certain areas, subsectors, and companies, because I need to remind folks that healthcare is vast, but it's also highly diverse, both in terms of industries, subsectors, but also within subsectors. So, but the conditions are in place for that outperformance to continue. Clearly, what was weighing on the sector post the election was just this sense of enormous policy risks, from whether it's RFK, head of HHS, now it's DOGE. Medicaid is very likely to be a significant pay for in the reconciliation package. So knowing how to minimize exposure to those particular risks while increasing exposure to, as you noted, very high quality companies, secular growth companies that are innovating, with smart management teams. I totally agree that's critical, that know how to allocate capital, that execute and gain share within their industries. And as these policy risks, some of them will persist, but as some of them abate, that will also fuel continued outperformance for a number of companies across the sector.
Yeah, there is still bright spots out there. I think it's so important for our viewers to hear that there are bright spots to make sure that you continue to grow your portfolio even during these times. And Scott, I'd love to hear from you. Analysts have suggested that we're seeing a rotation underway, people leaving the Mag 7 and going forward for value investing. You talked about this. Other areas like financial services, basic goods, global markets are starting to rise. If we see the rate cuts, it's definitely going to help the financial services sector that are involved in lending. Are there any adjustments investors should be making in reaction to this rotation? Or how do we know if this is temporary or long-term?
So again, our orientation has always been to be prepared. So we focus on what are my liquidity needs. David said before, if I thought I was going to lose my job, I want to make sure that I've got, liquidity. Well, the same holds true with my portfolio. If I think I might need money because I'm nearing retirement or I've got something coming up, my daughter's getting married, when I get a new client, I want to make sure that I'm not investing any money in the equity market that they're going to need in the next 5 years. Because I know if I've got 5 years, I'm making money in equities. Okay. But to your question, there's plenty of good places out there to get good yield. And I think in times like this, that's what people are looking for. Dividend paying stocks, I think, are going to be a beneficiary here. We're very interested in the private credit markets. You've got to be extremely careful there because now you're talking about non-publicly traded companies. So if you're going to have exposure to that, you'd better have a partner, a manager, if you will. And I'm not talking about us. We have managers that we love, but they need to be somebody that really knows how to go in there and really examine a company and really understand what the risks are and what that company looks like. It's almost like a private equity firm buying a company. You better really understand it. But in those markets, yields now are probably in the 9-10% range. And again, if you've got the right people looking over that and they've got the right positioning, you're not taking a lot of risk, a little more than, say, buying a AAA publicly traded bond. So that I think is an asset that's interesting. Mid-cap stocks are probably likely to do better. We're seeing non-US equities doing better because, again, they were trading at almost half the PE ratio of these large cap companies. And to David's point, I think we are going through maybe somewhat of a rotation. But when these stocks get so big, they move the markets for better or for worse. And when they're coming down, you are kind of fighting that headwind. But if your bonds are there to offset that drop and yields are good, and if rates do continue to come down a little bit, that's going to be accretive to your bonds. Our bond portfolios on the Europe about 2.5% in a couple of months, only because rates have come down. When rates come down, the value of your high quality bonds goes up. So I'm still optimistic. I think we're going to see people investing in different parts of the market. I think it's healthy. I'd much rather see an S&P 500 where there are 250 stocks participating in the upside rather than 7 or 8. That always made me nervous. There was a year last year or the year before where if you took those 7 or 8 stocks out, the market was completely flat. That's not good. So I think that while it's nerve-wracking, a little scary, if we don't panic, we haven't lost anything, right? It's like a game. We look at our portfolio balance is down. As long as I haven't sold anything, I haven't lost anything. This will pass. But I think this is a good time for people. It's a good stress test, gut check. Am I really as diversified as I thought I was? If you've got a portfolio right now that's down 4 or 5%, 6-7% on the year, you're clearly not. If you've got a good, well-diversified portfolio, you're not down much here, not yet. There's too much, positivity out there to outweigh some of these negative stocks. So I think that's probably a good thing to check in with your advisor on if you have one.
Yeah, some of the economic data, there's some conversation around stagflation and recessions. The renowned economics professor Steve Hanke was on Wealthion this week saying that he believes we will see a recession in 2025. And Jeffrey Solomon, the president of TD Cowen, is also warning clients that this might be a downturn on the horizon into recession. So Scott, you've seen this in the markets before. I know I have. There's been some blips and scares, and we've always recovered. But how do you help clients during this downturn? And what are some of the telltale signs that investors could be worried?
Well, I think people are getting worried. If this continues for a while, people will get worried, right? I mean, volatility scares people. Recession's a funny thing, right? I mean, people like to make fun of economists. They're all smarter than me, so I don't make fun of them. But a lot of people throw that word around. And I would tell you that a recession doesn't necessarily mean the market tanks either, right? All we're talking about is a specific slowdown in GDP, right? So, just because there's not growth in a fairly narrow period of time, that doesn't mean it's the end of the world. So you might be right, you might be wrong. I do think that there's opportunity out there still. I do think that if our clients are positioned correctly, they've got enough liquidity to get through this, there's going to be an opportunity to buy some stocks cheaper. If I've got a 5 or 10 year time horizon, I'm always going to win if I own quality securities. So, again, it's taken me a long time, Terry, to insulate myself emotionally and take that out of it so that I can be a good advisor to my clients and focus on what really matters. And what really doesn't matter is what happened today, right? What happened today, quite frankly, is more people were selling and buying. And very well, there might be more people buying tomorrow. There's always a lot of headlines. A lot of people will explain to us what happened. Sometimes they'll give us an explanation for this down market today. They might have given us a similar explanation to why it was up 3 weeks ago. Sometimes good news is bad news and bad news is good news. But in the end, it's all about positioning. It's all about liquidity. It's all about diversification, own quality stuff, be patient. I think if people would just bear that in mind, I think they're going to do a whole lot better. Have a plan.
Yeah, have a plan is absolutely true. I also think, for viewers that may have not lived through a recession yet, we've been through several and we do recover. I mean, the markets are a great testament to say, we've been through this before. Markets have hit highs as a result of it, but what goes up must come down at times and something we should consider. But David, if you were a 30, 40-year-old investor right now and you're looking at your portfolio, what should you be thinking about?
Yeah, I mean, to Scott's point, diversification, stick with a plan, be patient, maybe turn off CNBC.
Yeah.
And don't get too activated by the volatility we're seeing. And then the general news media, and to the extent people are on Twitter, that's even worse, but is heightening these fears in many respects. So turn that stuff off, but just be disciplined, stick with a plan. Don't try to trade out of it just because you're reading somewhere that somebody made, $100 million on Reddit trading. Just be disciplined, I think is the key. And to your point, time is your friend. So let returns compound. And to Scott's point, you're going to exit at the wrong time. So stick with stuff. And if you're a stock investor like me, know what you own, have high conviction, make adjustments where necessary to avoid risk. So for example, what we've done, we've sold stocks that have been very, very strong performers for us, the hospitals, because of their inordinate exposure to Medicaid, or some companies that have high exposure to NIH funding, which is now somewhat imperiled given the cuts and what's going on in academic research, or that have tariff exposure. Not a lot of our companies have that, fortunately, but to the extent some do, make your adjustments if you have done the work and you think that's a real risk, and reallocate into areas, you said, value stocks, high dividend payers, strong growth companies that have inelastic demand that are not subject to economic cycles like others. So lots to do, but again, be disciplined and stay the course.
I love that. And then, we have another week of numbers and data coming in. CPI is expected, PPI is expected. Scott and David, are you expecting any more volatility next week, or what should investors be thinking about next week?
I think the elevated volatility is here to stay for a period of time, just because there's just so much uncertainty. Investor sentiment is really, really taking a beating. But there's uncertainty on the macro front. We're getting a lot of mixed messaging. I saw Lutnick tried to, they're playing good cop, bad cop, but it's creating just sort of a seesaw effect. policy risks. We have the reconciliation package, which will need to get passed mid-yearish or so, and that's going to create a lot of volatility given the uncertainties as to pay fors, how's the vote going to go. So I think it's going to be here to stay. But again, try not to be too activated by it, I think would be the best advice.
Yeah, I would agree with that. And as David was talking, I was thinking, Peter Bookvar, who's our CIO at Bleakley, and, a dear friend of mine and David's. He's probably the smartest guy that I know in general. I can remember having a conversation with him around December, and, he's on TV quite a bit, and he's on CNBC in the mornings typically. And Joe Kernan in particular likes to make fun of him, Dr. Doom and Gloom, he likes to refer to him as, because he's got a very realistic perspective. He doesn't get carried away either way. I can remember talking to him back in December, and I said, well, what are you thinking? Like I'll typically ask. And he said to me very specifically, sentiment's just too strong out there. People are way too optimistic about markets. When everybody out there is optimistic about the markets and the sentiment is so positively strong, that's when you start worrying a little bit. When everybody out there is really negative, and everybody out there is really worried, and people don't want anything to do with the market, that's when you want to start thinking about maybe dipping your toe in. And again, I don't think we've seen enough downside to really create a huge opportunity one way or the other. But the more negative people get, the more optimistic I think we should be from the perspective of having an opportunity. People have their eyes on an expensive pair of shoes, and it gets marked down 50%, and they bolt for the mall. The market trades down by 15 or 20%, and everybody's looking at their shoes, right? Literally looking down. The markets are counterintuitive. It's been like this forever. Unfortunately, human nature is what it is. So, we can't help ourselves. We are the creatures that we are. But I think that there's probably going to be an opportunity here. Very, very hard to get rattled by it. I mean, I don't like looking at it, but we got a long way to go, I think, before people should start getting really worried here.
Yeah, we saw in 2024, the market exuberance, right? Which is that the height of the market, you have all this consumer exuberance about the stock market, and then it does come down. And this is a regular cycle we see in the market until we get to some pessimism here, pessimistic behaviors. But as Scott said, that's actually a sign that things can be getting better when we actually hit the bottom. So we don't know when that is, but we do know it exists and it will come back. And Scott and David, I just want to thank you so much for being with us today and sharing your perspective and your experience in markets like this. It is so valuable. For all of our viewers out there, we'd really like to know what you think about Rise Up. We're just getting started. We do want to hear from you. What topics should we cover regularly? What do you want to hear? What do you not want to hear? We're really happy to answer any questions that you have. And if our conversation really sparked a few questions from you, we'd like to invite you for a free portfolio review from one of our trusted RIAs, like Scott and David at Bleakley Financial Group. Just go to wealthion.com/free and click the link for the description. We look forward to seeing you here next week.
Happy birthday, Terri.
Thank you, guys.